All right, let's get right into it. For years, Ohio's housing market was kind of seen as this bedrock of stability, right? The one place you could count on in a pretty chaotic national landscape. But here we are in 2026, and that foundation, well, it's showing some really unexpected and pretty serious cracks. So today, we're going to break down what is really going on.
I mean, this was the pitch, wasn't it? While the coastal cities were having these insane bidding wars and prices were going through the roof, Ohio was supposed to be the grounded, predictable safe haven. A place where you had these modest home prices and dependable jobs in fields like manufacturing and healthcare. The whole idea was that things just wouldn't get out of hand there.
Well, because that whole story is changing, and it's changing fast. All of a sudden, price cuts are piling up, and houses are just sitting on the market way longer than anyone thought they would. So the big question is, why? Why is this supposed safe haven suddenly looking so vulnerable? That's what we're here to figure out.
To really get why things are stalling out in 2026, we have to rewind a little bit. We've got to look at those boom years and see how the very things that made Ohio so attractive actually planted the seeds for the problems we're seeing today.
It's kind of wild how quickly this all happened. Before 2022, the market was honestly boring in the best possible way. It was stable, it was affordable, then boom, the boom hits. It was fueled by this huge flood of outside investors and remote workers who were all chasing a bargain. But that kind of party can't last forever. By 2025, those climbing interest rates and inflation really started to bite, which brings us to right now, in 2026, a market that is under some serious strain.
Okay, so let's get to the real core of the problem here. Because this isn't just about interest rates. No, this is about a fundamental mismatch that got created between the price of a house and what a local paycheck could actually support. So here's the crucial point. You had this flood of out-of-town money coming in, just looking for deals. All that investor activity, plus the arrival of these higher-paid remote workers, it artificially inflated home prices. It created a market that really was no longer built for the teachers, the nurses, and the factory workers who actually power the local economy. And this, right here, this just brilliantly illustrates that disconnect. On one side, you've got home prices just shooting up, totally driven by external demand. And on the other side, you've got local wages, the ones tied to those essential, stable industries like manufacturing and healthcare that just did not keep up. An unsustainable gap was forming right under everyone's noses.
And this quote from our source material, wow, it just cuts right to the heart of it. The market became affordable on paper if you were an outsider, but in reality, it became fundamentally overpriced for the very residents whose incomes support these communities day in and day out. But here's the thing. The asking price was only part of the story. During the boom, buyers were so focused on winning bidding wars that they completely overlooked a critical factor, the hidden costs, the ones that come with Ohio's older housing stock. And now, those costs are coming back to bite.
Now, what's so interesting here is how these costs all pile on top of each other. We're not just talking about needing a new roof. It's also failing sewers. It's rising insurance premiums because of new weather risks and sky-high utility bills from these drafty, poorly insulated old homes. During the frenzy, this stuff just got ignored. Now, these unexpected bills are derailing deals and putting an immense financial strain on new homeowners.
So, where is this pressure showing up the most? Let's zoom in and look at a few specific cities that are basically perfect case studies for these exact patterns we've been talking about. Okay, first up, Springfield. It's nestled right between Dayton and Columbus, and its promise was super simple, affordability. For buyers and investors who are feeling the squeeze in those bigger cities, Springfield seemed like the logical next stop, right? But that boom was built on some really shaky ground. Local paychecks in fields like logistics and manufacturing just didn't rise with those home prices. So the second interest rates started to climb, that gap became totally impossible to ignore, and the market just stalled. It's a classic example of a city becoming overpriced for its own workforce.
Next, let's talk about Columbus. For years, this was Ohio's shining star. It's got a massive university, it's the state capital, it has a growing tech scene. Everyone just assumed its growth was unstoppable, basically guaranteed. So what's the reality today? Columbus is what you'd call a market that was priced for perfection. Prices surged so incredibly high, based on this assumption that the good times would never stop, that now even households with 2 solid incomes are feeling the squeeze. And when a market has zero room for error, even a tiny slowdown can have huge consequences.
And finally, Cleveland. The sales pitch here was all about potential. It was marketed as the ultimate bargain, right? A city on the cusp of a comeback where investors could get in on the ground floor of this major revitalization.
But the on-the-ground reality is that Cleveland basically bundles together every single risk we've just discussed. We're talking a shrinking population, crumbling sewers, rising insurance costs from being right there on Lake Erie. The gap between that comeback story and the economic reality, well, it's maybe the widest in the entire state, which makes it the most exposed.
So after this little tour of Ohio's cities, what's the big takeaway? It's that the old rules, they just don't apply anymore. Simply looking at the sticker price of a home isn't going to cut it. You have to dig much, much deeper.
So this brings us to a new playbook, really, for evaluating any housing market, not just in Ohio. First, you got to look past the price tag. Second, analyze the health of the local job market. Can local wages actually support these prices? Third, calculate the true cost of ownership, and I mean all of it: repairs, utilities, taxes. And finally, investigate those hidden risks, the ones tied to aging infrastructure and rising insurance costs. This is how you avoid buying into the hype and really focus on the fundamentals.
And that really leaves us with this final, crucial question. Because at the end of the day, the health of any housing market anywhere comes down to this: can the teachers, the nurses, the logistics workers, the manufacturers, the people who form the backbone of a community, can they actually afford to call it home? If the answer to that is no, then the foundation is a whole lot weaker than it appears.